So most people lose money in whole life insurance, and that's why Dave Ramsey hates it. And in fact, I did too, until I actually wrote my own policy. Here's what I did. So here's the thing I made as a mistake. Now, 20 years ago, I was a financial advisor. I had never heard of infinite banking. I only told people about whole life insurance that it was a mistake, right? Don't do it, it's a waste of money, it's a ripoff. But of course, after I started to wake up to this whole new world of passive income and investing and real estate and things like that, all these real estate investors started telling me how amazing this whole life insurance policy was for them. I said, oh my goodness, why? Isn't this a ripoff? No, it's awesome. You can actually be your own bank and do this and this and this. Eventually I started looking into it, drank the Kool-Aid, met with one of the agents, bought a policy. I was putting in $1,000 a month. This is in 2006. Now I was doing that. Now I remember looking at the policy, even before I bought it, I said to the agent, I said, this seems really expensive, even more so than if I could do another policy on my own with other types of insurance, like universal life or things like that. I was like, can't I pull different levers and make this more cash rich up front? And the agent said, no, whole life doesn't work that way. In fact, if you try to put in more money, you'll get taxed on that. So don't do it. I said, all right, I'll take your word for it. 2 years later, 2008 rolls around. I'm in the hole. I can't even make most of my bills. I can't pay anything. I definitely can't afford to pay $1,000 a month into this policy. I'd paid $25,000 into my policy. When I called the insurance company, I said, hey, can I stop making payments? They said, no, if you do, you'll lose it. And so what happened? I lost the policy. $25,000 gone. Months later, I started doing my own research. I started to look into it myself, not just trusting that agent I was talking to because I had an insurance license myself. I started to look it up, realized he was wrong. I could have actually had cash in there from day one. In fact, if I had done it the way that I was discovering, I would never have lost that policy during the Great Recession. So I approached that agent. I said, listen, I've actually found a better way to do this. And he argued with me. He's like, no, you shouldn't do it that way. And I said, well, yeah, but this way is better. No, but you need a higher death benefit. Okay, well, I'll match your death benefit. Look, I still have more cash in this policy from day one. Yours had no cash in it after day 1,000. So come on, give me something here. And finally, he just said, Chris, I did it that way because I couldn't afford to cut my commissions. I said, there's the truth, and there's a reason why I'll never send you any of my friends and family to you ever again. And by the way, he's no longer in the insurance business. He's now out of it, working for a bank at this point. And so that's the thing is I started to realize we could have done this better. And so really over the last 17 years, I've been really refining this and making it better to the point where I was able to buy my own policy, set up my own policy, and it was awesome. Cash available from day one. Where I set up a policy, for example, I set up with $40,000 in the first year. I would do $40,000 a year. Well, guess what? That first year, how much do I have in there in cash? I've got $33,000. Not zero, but over $30,000. And then by the fifth year, I have more than what I paid into it. Understand, I thought it would take you 15 to 17 years before you finally had as much money as you paid in. That means when I was paying $1,000 a month or $12,000 a year, I thought I'd have to pay in $180,000 before I finally had $180,000. But no, I did it faster. I had over $200,000 within 5 years. How did I do it? That's what I want to share with you right now. Because most agents won't do this. Here's the problem. Just like my old friend there, right? He did this. He did one of two things. Even though he knew you could do it, he refused to do it because he didn't want to cut his commissions. And this is what I find all the time is one, insurance agents either don't know how to do it. They don't know which levers to pull, especially if they work for certain insurance companies. The insurance companies don't want them to learn, so they won't teach them. Or the insurance company's not very good at trying to lower costs anyways. They'll just say, this is the way it is. You got to do it this way. So most agents, I would say, are ignorant to the fact that they can do a better policy. But there's still a small minority that know you can do a better policy, but then refuse to do it because they still don't want to cut back their commissions. So they'll do something in the middle, right? This is what I found years later when I did refer to another guy, is that they were doing a good job and maybe they'd have 2/3 of their money in the first year, but not 80%. No. I thought 2/3 was amazing. It's if you get 70%, I thought, oh my gosh, that's incredible. I was so happy. That's way better than 0%. But then I found out later, again, doing my own research, doing my own thing, I could do it even better. And it's not just about what's available in year one, it's how much cash do you have to use right away. Not just for emergencies, but even for investing. And that's what I want to design, is I want to design a policy for myself that as an investor, it makes sense. It's not like, oh, I'm taking all the money away from my investments. I'm just, slowing my growth. No, I want something that actually worked. So when I design a policy, I have people fund it with their emergency fund. The money they have sit on the sidelines anyways, that's not going to be used to invest, that funds those first few years where there's a net cost. But by the way we fund or create our policies, by year 3, there's a net gain. So every dollar you're putting in, you're making more than what you're putting in. And now it's like a tax-free supercharged savings account at this point. And so that's the kind of secret I use. So what do? We lower the death benefit. We use this blend of like paid up additions riders and term insurance riders and things like that to lower the cost of the policy so that more money goes to cash while keeping your death benefit lower. Now, somebody might say, what if I want a bigger death benefit? You could do that. You could still make it work, but it just won't be as cash rich. But here's what I did for my situation is I got like this optimized great policy, and then I got a term insurance policy on the side so I'd have more death benefit. That's what I did. And same thing with our clients is that I set up our clients' policies the same exact way that we set up our own. No difference. In fact, there are clients of mine that get better returns on their policy than I get. Why? Because they're younger. Now, if somebody's my same age, I'm about to turn 48, if they're my same age, they'll get the exact same policy I would set up on myself. Every single time. No exceptions. Doesn't matter if you're putting in a lot or a little. We don't play that little game where someone might give you a better deal because you put in a couple $1,000,000. I do know a guy that did do that with a friend of mine, but he wouldn't do that for his own brother, his younger brother. So I was like, no, it's the same every time. No BS, no hassle. Now, how can you know you get the best one? The best thing to do is ask for the numbers. Don't make them take you through the whole underwriting process before they give you numbers. Have them give them to you up front and then do an apples-to-apples comparison between different companies. Shop it around. I mean, you do it anyways, right? You go on Amazon or you're going online, you're shopping around. Why not do it with insurance? In fact, we invite you to shop around because you'll come back and know we still got the best deal, right? So that's what you should be doing. This is the kind of things you should be looking at and asking for. So ask for those numbers up front. If they won't give it to you up front, they're playing the little sales game with you, don't use them. They're out, right? If they're trying to hold back and say, no, I don't want you to have those numbers, it's because they're scared you're going to share it with somebody else and they're going to get their numbers beat. Don't do that. If you get true apples to apples, you can do that. By the way, people that already have policies, they've done that with us too. Like, hey, apples to apples, is this still a good policy to have or not? We look at that. And there's many times we might say, don't change what you got. That policy is fine, leave it alone. There's other times we're like, you got to change it now. Like with a dentist, literally we saved them $2.25 million in costs, which means they had a $2.25 million more of tax-free cash that they could access after 20 years. That's a big deal. So in those cases, yes, that should be the case. I had another guy that was like that younger brother that they were overcharging him at $1,000 a year. $1,000, have that go to yourself and your family, not to the insurance agent. It's not worth paying their family when it takes away from yours. You can do it the best way, the right way. And so the best way to do that is obviously shop around. Feel free to let us throw our hat in the ring too, by the way. In fact, if you already have a policy or not, or if you just want to look at see what it is, hey, just go to our website. You can go to moneyripples.com/infinite-banking and just get on a call. And again, no cost to you. We can just look at it, no pressure, and just see what's the best strategy for your situation today.